Net income year-to-date is up about $36 million. We've been able to add over $25 million to our surplus, and a lot of that is driven by a very strong investment result. We've been well ahead of our investment plan all year. In June, when the equity markets kind of collapsed somewhat, we still were able to maintain our advantage to plan by almost $2 million. Our balance sheet looks terrific. You know, we've got over $25 million more surplus. We've had 2 loss reserve committee meetings, and our loss reserves look very, very strong. Cash flow has been very good again this year. So when we put it all together, we have a very strong balance sheet. We're well poised for growth. Probably our biggest opportunity is to continue to put the capital to good use and to profitably grow our operations. First half of this year, the biggest change over the last couple of years is we're seeing some momentum on the premium side. The last few years it's been difficult to grow now for 3 or 4 years. It's still difficult to grow. It's still an extremely soft market, particularly in commercial lines. But we are seeing some pretty good momentum. We've got our commercial lines platform and new product in all of our states except for Florida, and then a couple of the new states from GDM, which will be on the plan for next year. But new business is up. We're seeing some pretty good momentum in the marketplace. From a loss ratio standpoint, the loss ratio is holding quite well. We've had more storm activity so far this year than we've had in the last couple of years, and we're hoping to see some quiet the rest of the year. From an investment standpoint, our investment folks continue to perform extremely well, even with a very rough June in the equity markets. We continue to be above our investment plan year to date. So far this year, the combined ratio is actually doing pretty well in spite of the storm activity. And when we break it down, there's some really good news, and there's some areas that have some real room for improvement. The personal and commercial lines operations combined through June have a combined ratio of 95.7. When we add in the bond operation, which is about 108 or so, and the assumed reinsurance operation, which is around a 112, it brings the total operations up to about a 97.6, so slightly ahead of our 98 plan. So that's pretty good news. When we add the grain dealers in, it brings it up into somewhere in the mid-99s. Grain dealers had a very, very difficult storm in Oklahoma. Oklahoma hit us really on the grain dealers book. It also hit us on the assumed reinsurance book. We know that Oklahoma's historically been a volatile market, but this year and frankly last year are probably 2 of the worst years on record in Oklahoma. So we're just a bit unlucky, but that's really what we're here for. That's what we're in business for. And even in spite of the large loss, and it was a big loss. GDM's loss in Oklahoma is about $7 million. The assumed reinsurance loss was over 4, so that's about over $11 million loss for the group. In spite of all that, to still be under 100 when we add everything together is quite good. As far as our comparison to the industry, from a premium standpoint, we're outperforming because as I mentioned, our net premium is up over 5%. Our direct premium coming out of the personal, commercial, and the bonds operations is up north of the 2%. The industry itself is actually slightly shrinking, and the projection for this year is for it to continue to shrink. From a combined ratio standpoint, the industry is projected to be over 100, and we're under 100, so we're doing quite well.